Welcome to This Explainer. Today, we're diving straight into the deep end to deconstruct the complex mechanics of setting up a foreign-owned corporate entity and, most importantly, securing that absolutely crucial tax identification number. Now listen, we are totally bypassing all the generic surface-level advice today. We're going to act as a specialized analytical engine, focusing entirely on the hidden architecture and those rigid cause and effect loops that literally dictate global business operations. Because a single misunderstanding of this infrastructure, well, it doesn't just mean a rejected application. It can actually lead to frozen funds, massive compounding compliance fines, or just a complete inability to ever launch your product in major markets. So if you want to master the precise legal and financial framework needed to operate seamlessly from entirely outside a target jurisdiction's borders, you are definitely in the right place. Let's break the whole shebang down.
Okay, so here's our roadmap for deconstructing this mechanism. We'll start with overcoming geographic financial barriers, then move right into the crucial identification mechanism and its systemic application bottlenecks, before exploring pass-through taxation dynamics, and finally, essential reporting and compliance.
All right, let's jump right into Section 1, Overcoming Geographic Financial Barriers. We first need to analyze the core paradox facing global commerce operators today.
So this question highlights a really fundamental friction. Think about it. For decades, legacy banking systems have demanded a physical presence, a local address, a resident founder, or a specific visa. And this was primarily used as a mechanism for risk mitigation and identity verification. It was basically an inflexible physical wall. The implicit assumption was always that to do business in a country, you literally had to physically go there. But according to anonymous expert reports analyzing modern corporate structures, we're seeing a profound shift. We now have the mechanisms to bypass this physical requirement entirely, and we can do it without triggering the traditional alarms of those legacy financial institutions.
And the solution to this friction lies in establishing what experts define as a remote pass-through architecture. By legally incorporating in specialized, business-friendly jurisdictions, global operators can create a remote entity that completely severs the tie between physical location and financial access. It's kind of like creating a localized financial avatar or a proxy. You absolutely don't need a visa, you don't need to step foot on domestic soil. And while the physical tie is totally severed, the legal and financial ties are fully integrated into the domestic system, which allows for seamless global commerce. Your corporate avatar effectively opens the gates for you.
Moving right along to Section 2, the crucial identification mechanism. Because simply registering this entity is not enough. We have to examine the absolute linchpin that makes it fully operational.
Let's be real. A piece of paper from a state registry cannot hold funds or process credit cards. Without this specific 9-digit tax identification number, even the most brilliantly designed global business is just entirely locked out of the world's largest consumer markets. It's literally the binary switch for monetization. Domestic banking institutions and digital payment processors essentially view a company without this number as non-existent. Securing this identifier is what integrates your localized avatar directly into the domestic tax authorities' tracking systems, instantly switching your status from a dormant concept to an active financial participant.
Now, the acquisition of this number operates on a strict, totally inflexible algorithm. You can't just jump ahead. First, you've got to exist as a registered legal entity. Second, you must officially assign a responsible party, basically an individual who ultimately manages and controls the assets. And only then can you execute the third step, actually applying for the identification number. But here's the catch. While the first two steps might take mere days to process electronically, this final step introduces a massive structural bottleneck that completely derails international operators who just aren't prepared for it.
Which brings us to Section 3, Systemic Application Bottlenecks. To truly understand this delay, we've got to look at the clash between the digital age and analog bureaucracy. Analysis reveals a fascinating yet honestly highly frustrating dual-track system. If you're a domestic citizen, the system instantly cross-references your personal social security identification and boom,
It issues the corporate tax number in minutes, entirely online. It's completely automated. But lacking that domestic identification completely blocks foreign founders from those automated systems. You could literally be launching a cutting-edge artificial intelligence platform, but to actually get paid for it, the system forces you to rely on 1980s fax machine technology or physical international mail to submit paper forms to the tax authority. The irony is staggering, right? But the requirement is absolutely non-negotiable.
And the operational reality of this manual, paper-based queue is a massive global average delay of 20 to 30 days just to receive your 9-digit identification number. This is a vital piece of non-obvious intelligence. See, a lot of founders enthusiastically plan their product launches assuming they'll have a bank account and payment processor ready to go in a week. That is a critical error. Manual queue dictates a strict waiting period. You have to factor this 30-day dead zone into your operational timeline and make sure you have the capital runway to survive a full month of being completely unable to process a single transaction.
All right, Section 4, Pass-Through Taxation Dynamics. Once your identification number is finally secured, we need to deeply analyze the rules governing how this entity is actually taxed.
So there is a ton of misinformation out there about foreign-owned entities and domestic obligations. If strict operational parameters are maintained, meaning absolutely no physical offices, no local employees, and exclusively remote operations, the limited liability structure becomes incredibly powerful. Think of the corporate entity as a transparent glass funnel. The revenue enters at the top, but the domestic tax authority doesn't stop to examine or tax the funnel itself. No, they look right through it to the hands holding it at the bottom. You, the foreign owner. The tax liability literally passes through the corporate shield directly to the individuals.
Because the entity acts purely as a transparent funnel, the financial tax obligations shift entirely away from the domestic jurisdiction and land directly in the founder's local home country. Now let's be clear, this isn't some shady loophole. It's a deliberate systemic feature of how territorial and global tax codes interact. If your home country taxes global income, well, you simply pay your taxes there. But if your home country doesn't tax foreign-sourced income, this entirely legal remote structure creates an incredibly efficient tax dynamic. The domestic tax authority essentially steps out of the way, and your home laws step in.
Finally, let's look at Section 5, Essential Reporting and Compliance. There is a very dangerous assumption out there that zero tax liability means zero paperwork.
The absolutely critical metric you have to understand is that financial tax liability and informational reporting are two completely decoupled mechanisms. This is a massive logical trap where the highest number of remote founders fail. They just assume that because no money moved or no profit was made, no paperwork is required. That is entirely false. Even if your entity has zero revenue and zero expenses in its first year, you are fundamentally required to maintain strict informational compliance with the domestic tax authority. Let me repeat that. No revenue does not mean no reporting.
The tax authority absolutely demands a paper trail. They want to systematically verify that the entity exists, who owns it, and that it was legally formed, even if it didn't generate a single dollar of profit. Failing to file these seemingly empty informational forms doesn't just result in a polite warning letter. No, it triggers severe, compounding flat rate penalties that can quickly reach tens of thousands of dollars, completely destroying the business entity before it even fully scales. Ignoring informational returns is literally the fastest way to systemic failure. Understanding your precise legal classification is an absolute necessity when you're setting up operations. When you're the sole foreign owner of this pass-through structure, you're viewed by the system as a disregarded entity. Now, I know it sounds terribly negative, but it's actually a highly specific and very useful legal designation. It literally means the tax authority disregards the corporate shield for assessment purposes. Checking the wrong box on a form simply because disregarded sounds bad is a frequent catastrophic point of failure for foreign founders. You've got to embrace and accurately report this exact status. Executing these non-obvious compliance steps perfectly is your financial armor. When you finally connect your identification number to third-party payment processors, you're going to face specialized foreign status forms.
If their automated algorithms cannot definitively prove your foreign status, maybe because you failed to declare disregarded entity correctly or didn't provide your local tax number, their default programming is to instantly seize up to 30% of your gross revenue and hand it straight to the domestic tax authority as a withholding tax. Filing these forms accurately is exactly how you override that algorithm and protect your capital. As you leverage this financial gateway to scale your global enterprise, you've got to continuously monitor this extremely delicate balance. The frictionless pass-through is not a permanent guarantee, guys. The precise moment you decide to hire a dependent local sales agent or store inventory in a physical domestic warehouse, the entire tax matrix we've analyzed today shifts fundamentally. You cross the line from a remote proxy right into a localized, taxable presence. So, I'll leave you with this thought. How closely are you monitoring your operational footprint to ensure your digital entity hasn't secretly become a physical one? Keep analyzing the data, stay rigorously focused on compliance, and I will see you in the next explainer.